We had everything going for us today, but did the Fed just break the stock market rally? That's the question on the minds of investors after Jerome Powell pulls a surprise bit of communication and the markets do not like it. We're going to figure out exactly what just happened and what it means going forward. Macro Money starts right now. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Boy, did we have a day today. The markets were going into the Fed policy announcement expecting that the rate cut that they had anticipated was essentially a foregone conclusion. As it happened, they did get that rate cut, so the markets weren't wrong there. But as we discussed yesterday on this very show, the likelihood seemed to be that the markets were so priced for perfection that any little tiny bit of a disappointment could get them in a bad way. And we got that today. And it seemed like the Fed chair really meant for that to be understood with the level of gravity that the markets took it. Now, certainly, it doesn't look like the Fed chair was hoping for a sell-off, and I certainly wouldn't suggest as much, but he certainly wanted to tell the markets something different than what they had benchmarked in their expectations. And that is certainly what we ended up getting today. Because, of course, looking at how all of this ultimately played out, we have a very significant revision of what the markets think is coming up next for monetary policy. And that has absolutely reflected itself in how these assets performed. So what we'll start with here is a look at the price action. Let's jump there immediately and take a look at what happened. As we can see, a little bit of a soggy response from the S&P and the NASDAQ. They ultimately don't go anywhere. S&P finishes basically unchanged. NASDAQ a little bit higher. That's in large part around expectations that we still had these earnings reports, which we'll take a look at in just a second, from some of the big tech names on the menu before the markets closed. And so obviously with those after the bell, nobody really wanted to jump out too far in front, but the initial reaction to what the Fed did was certainly negative. S&P fell, NASDAQ fell, and everything kind of felt like there was a level of disappointment with what the Fed ultimately unveiled. We can see that clearly in the rates. The 10-year up 2.5%. 2-year up more, 3%. The long end, the 30-year actually was the least changed of the bunch, thankfully, because that's the one where I actually have exposure along the bonds, and so indirectly short the yield. Gold fell. The dollar strengthened across the board, up meaningfully against the euro and the yen. Bitcoin showed where risk sentiment would have gone, perhaps, if not for expectations for these earnings. That's off 2.3%. And crude oil managed a little bit of a recovery, but that's, of course, in the wake of this aggressive jostling in crude oil. Last week, of course, we had a big rise, 7.6%. This week, we've recovered a little bit after a good deal of that rise started to come off the board. Apparently, the markets are not as concerned about sanctions on Lukoil and Rosneft as maybe they were initially, and maybe they're not as concerned because what we end up with is still this meeting between the presidents of the U.S. and China on the menu, and perhaps there is some degree of conversation about maybe this meeting will give us an opportunity to reset some of what's annoyed crude oil. Obviously, these sanctions around Rosneft and Lukoil hit at companies doing business with them, and the largest buyers of Russian crude are, not surprisingly, China and India. And so maybe there's some sort of a grand bargain to be had with Xi Jinping around giving them some degree of a dispensation on those imports. So we don't as yet have a convincing sort of rally here, and crude oil, although it's up a little bit today, is on the whole seeming to unwind or be inclined to be unwinding last week's gains, and so far no sign that this little rebound today changes that story. On to the Fed, the policy statement here, not terribly controversial. You'll notice the change here in the language from available or from recent data to available data, because of course the government shutdown continues and there is no data, certainly not in the volume that Fed officials would want to see it. We get the sense that the economy has been expanding at a moderate rate. Job gains have slowed. We see here that there's a very clear kind of distinction being made that the unemployment rate edged up but remained low as of August. Of course, we would have had the September NFP number by now, but we don't. And the Fed still seems to be signaling here that more recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. No big shockers there. The COT is on the menu as might have been expected. 0.25 percentage point. Once again, the Fed is saying that risks to employment have increased in recent months. And we've got a pair of dissents here. So Jeff Schmidt dissenting in favor of holding rates unchanged this time. And shock of shocks, Governor Stephen Miran dissenting in favor of a 50 basis point cut. So we know who the hawks are. We know who the doves are. Shocking this is not. But sort of your usual suspects, people like Chris Waller, people like Michelle Bowman, they have been advocating rate cuts, but they were with the majority, with the consensus on a 25 basis point move. The real action-packed part of this came from what Fed Chair Powell said at the press conference. And here's some of the choice comments. Data before the shutdown show the economy could be firmer. Labor demand has clearly softened. Balance of risks shifted on employment, so we went to a more neutral stance. This is all familiar stuff. Fed's been saying this for months. Here's where the kicker is. There are different views about how to proceed in December. In fact, they are strongly differing views. And here's the punchline. A further rate cut in December is not a foregone conclusion. Far from it. Now, the Fed chair reiterated this multiple times. Moreover, when asked about it again and again and again in the Q&A, he said, look, I come out here after every meeting and I tell you that each future meeting is live and we're data dependent and we're not going to do anything unless the data supports it. And that's sort of the usual song and dance I do. I am saying more than that here. as if to very clearly tell the markets, listen, I know I always give you the same disclaimer. This is not the usual disclaimer. You all think there's a 90+% chance that we're going to cut again in December, and I'm telling you it's not that high. So that's really what the markets responded to. Adding on, he's saying September and today were risk management cuts. That's around that changing balance of risks on the labor market. And that's not the case going forward. We don't know what data we will have in December, but if there's a significant change in the economy, we'll pick that up. Optimistic. But here's the key. What do you do if you're driving in the fog? That is, you don't have data. You slow down. In other words, you don't just keep cutting if you don't know where you're going, because the data is not showing you. There's a sense from some, and perhaps Powell is including himself in this calculus, of saying, let's pause. And there's a sense from others, Stephen Mirren, let's go ahead. There was a couple sporting comments about AI, but that was hardly the main story, saying basically it's not the same kind of bubble as the dot-com bubble, et cetera, et cetera. And it's obviously a big driver, AI investment, a big driver of growth. Yes. Thank you, Jay. We know. So pretty straightforward there. But we can see what this immediately does to Fed policy expectations. We saw perhaps even the possibility that we might get a 50 basis point cut at this meeting. Well, that's clearly off the table. And instead, what we're looking at is a much more even spread in the case for a 25 basis point cut. We're still better than even odds here, north of 60, but only just so. Whereas now there's a non-negligible over 30% chance that we're going to stay put in December. And of course, that lines up with what the Fed ended up giving us. Now, they have 3 cuts on the forecast, but how did we get to these 3 cuts? Well, we took the median of this, which was 2 cuts for this year, and we spiked it with this. I'm not going to say this is Stephen Mirren's dot, but you be the judge. Very dovish sort of disparity. And so it was by a very narrow margin that we ended up with 3 cuts here in this forecast, which is what 3.6 represents. We still have the disparity into next year. Of course, the markets are more dovish than the Fed is here. The Fed is saying a quarter basis point only. But it looks like this conflict here between a majority that thinks 50 basis points this year is enough and this outlier, it looks like that conflict is now front and center. And you can see we got a little bit cooler on Fed rate cut expectations for this year. We've still got 64 basis points on the menu for next year. That's still in excess of what the Fed is saying. This is about 2 cuts and a slightly over 50% chance of a third, about a 55-ish% chance, 56 of a third. So slightly better than even. But we can clearly see that the dovish extremes here are giving it up. And we can see also that we don't really have a very strong reaction, but this now is the key question. Can we get this easing at the same time that stocks continue to power higher? And obviously, we saw today was ultimately a kind of very small day for the S&P, so we don't really see a big wiggle there, but intraday, the markets really didn't like it. For the dollar, clearly this has been a boon, and the dollar has made a higher high here. As a matter of fact, we're looking at the highest levels since July for the dollar's average against its major counterparts. So this seems to be working fairly consistently. In fact, the dollar seems to be on this march higher. Whether Fed policy expectations get worse that is more dovish, or better for the dollar that is less dovish. And so the dollar just seems generally strong. In fact, it hasn't made a lower low since July. So it seems to be minded to go higher. Over the next 24 hours, we're going to get a policy announcement from the ECB. No big changes expected there. In fact, no changes from the ECB really on the menu, even going into next year. Just 10 basis points with a slight easing bias, but not really anything of substance expected to occur there. Looking further on, we'll see, of course, what the ECB may or may not do. But as it stands, at least for now, it looks like they're in a holding pattern. We had a monetary policy announcement from the Bank of Canada overnight. They cut rates as expected by 0.25 percentage point. No big surprise there, but the guidance seemed to actually veer a little bit on the hawkish side, at least in relative terms, whereby it seems like the December meeting for the BOC is probably not going to bring us further easing. And so with that in mind, we have a little bit of a rally in the Canadian dollar on this. There it is. But of course, once the Fed comes out, it gets slammed right back down. And so ultimately, we still end up holding whatever this former support become resistances, and the trend down continues. The strengthening dollar continues. On the earnings front, a miss for Meta. Very much in line with expectations, and better for Alphabet and Microsoft. Microsoft sells off anyway, though the numbers end up being solid, but it comes back quickly. Meta gets shellacked. So we'll see how that ends up looking like when the cash equity open comes tomorrow. Alphabet ends up doing well out of the numbers. And of course, we have Amazon and Apple after the close tomorrow. As far as positioning is concerned, I've added a little bit of bearish exposure here. I am, of course, still very much long the US dollar. I've been short gold by selling calls here for a few days here since the beginning of the week. I added to it by selling the 1 ounce gold future, so I still have that. And the risk-off exposure I had going into the Fed was just this put vertical on Bitcoin through the IBIT ETF. I have now added a bunch of SPY put verticals as well. You can see I've put 2 of these spreads on, looking for some sort of a risk-off follow-through from here. Still long the long end of the bonds, and still short crude oil, looking for that to continue to retrench after last week's bounce. And that is macro money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, usually looking at the Wall Street close and where things may go therefrom. Also writing for the news and insights portion of tastylive.com. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.